Hello, and welcome to the 2019 second quarter investment call with the San Diego Foundation. I'm Brian Zambano, Vice President and Chief Development and Stewardship Officer at the San Diego Foundation. Thanks so much for joining us today. These quarterly investment calls are an enhanced service to donors. The calls provide direct access to our investment leaders in a consistent, convenient, concise format, so donors can remain informed about the performance of their charitable assets. Leading today's discussion will be Steve Klosterman and Matt Fettig. Steve Klosterman is Regional Director at Halbert Hargrove and serves as Investment Chair for the San Diego Foundation's Board of Governors. Steve advises a wide range of individual and institutional clients and began his investment management career more than 35 years ago, building his own registered investment advisory business. Steve is past chair of the UCLA Foundation and founding board member of the UCLA Investment Company, which oversees a $2 billion investment. As Chief Investment Officer for the San Diego Foundation, Matt Fettig oversees and manages our investment strategies and activities. This includes working with the Board Investment Committee, senior staff, auditors, professional volunteers, fund managers, and outside consultants to establish, maintain, administer, and monitor policies related to the Foundation's investments. Today, Steve and Matt will start the call with a brief macroeconomic update, followed by performance and attribution reports from our endowment portfolio and our long-term, medium-term, and short-term portfolios. We will conclude with a question and answer session. To submit questions, please use the questions chat function located on the webinar sidebar menu anytime throughout the call. Any questions unanswered during today's call will be answered via email. Attendees can access slides and a recording of today's call on our website at sdfoundation.org by tomorrow. Now, Steve Klosterman will get us started.
Thank you, Brian. Really, a lot of these questions go around market timing, and I thought these graphs would be helpful. This is showing the average return looking up to and following equity market peaks. So obviously, we don't know a peak until it's already occurred. But looking back for a very long time period, you'll see 1945 to 2018, 24 months prior to the peak, you had a 41% return on average. 12 months prior, 23% on average. 6 months prior, 15% on average. And just 3 months prior, an 8% return. Now, after that peak, you can see things get pretty ugly fast. Down 7% on average after 3 months, then 11% after 6 months, and down 14% 1 year later. But just pushing out to 2 years, to 24 months, on average, down 1%. So you just have to be extremely careful about what you read and what you think in terms of trying to guess when a market's peaked and when you get out. To carry that thought forward, on the next graph, this is the returns of the S&P 500 between basically 1999 and year-end last year. And the most significant part of this graph is the summary in the box. 6 of the best 10 days occurred within 2 weeks of 10 of the worst days. So you can get a lot of false signals. The best day of 2015, August 26th, was only 2 days after the worst day, August 24th. Then in a more granular fashion, you'll see this graph shows if you were fully invested, you had a 5.62% annualized return. So on a $10,000 investment for this time period, you now had almost $30,000. You missed just the 10 best days, and now your return has dropped to slightly over 2%, and you have less than half of the money, basically, if you miss those 10 best days. And it just keeps going, but you can see missing the 20 best days, you're now in negative return territory. So again, question anything you read that suggests markets can be timed are your own instincts. If you go to the next graph, you'll see that market volatility is normal. And actually, our current market volatility is about, measured by the VIX index for the S&P, its average is about 20, and that's about right where we are. It's just that it was extremely low before. It was less than half that at a point. So when you double the volatility from its low point, you feel that it's unusually volatile, but it actually is about average. Now, what this graph shows, all these pink dots represent an intra-year decline in that year. So for example, in 1980, at some point during the calendar year in 1980, you had a 17% drop. It could have been a matter of days, it could have been months, but sometime during the year, it dropped 17%. But the gray bar shows you finished the year in 1980 up 26%. Okay? So you just go through and you see all these intra-year declines for all these related years. But the key part of this graph is the summary at the top. On average, these intra-year drops were almost 14%, 13.9% on average. But the annual returns were positive in 29 of 39 of the years. So most of the time, the majority, you ended up with a positive return over 70% of the time. So again, we just don't believe markets can be timed. If you go to the next graph, and I think in many ways, this is the most powerful and important message, it's really about your time frame. A 1 month holding period, if you look at months, you had on average 60% of the time you had a positive return. And if you note, this goes back all the way to 1930. So pre-World War II. And you can see then if you go out to 1 year holding periods, 75% of the years were positive. Now you go to 5 year holding periods. So you're always adding a year and dropping a year. So in other words, 1930 to 34, 31 to 35. You look at these rolling 5 year periods, and now 90% of the time you had a positive return. You do that for 10 year holding periods, you're at 97%, and 15 year holding periods, 100% of those periods you made money. You had a positive return. Now, we do not have a portfolio that's as concentrated as the S&P 500. The S&P 500 is basically just large companies in the U.S. That drives that index performance. We have a much more diversified portfolio. So I would submit to you that if you look at periods of positive returns, we would have more periods of positive returns because of our extensive and informed diversification. So again, markets can't be timed, and it's really about time frame. And we're not going to react to short-term gyrations in the market. Thank you for your time and attention on that, and I'll address some other issues in the Q&A.
Thanks, Steve. So with that, let's look at investment results. Keep in mind these investment results are through the end of the second quarter, June 30th. And I know there has been quite a bit of volatility in the markets since. That said, through yesterday, the U.S. stock market, measured by the S&P, was still up over double digits for the year. So despite recent volatility, results have still been quite strong. You can see the endowment portfolio here. And to Steve's point, an endowment portfolio is meant to have a perpetual time horizon. We're seeking to deliver an inflation-adjusted return of greater than 5%, which is the spending rate that is distributed each year. As such, we take a very long time horizon when we are investing the endowment. And that leads to diversification, number one. It also might lead to some positioning that you would question. We have a big chunk in international stocks. Most have seen that we are in the semi-trade war with China, and that you have slowing to negative growth in Europe. And one might ask, why would you want to hold stocks in those countries? The answer is, on a long-term valuation basis, those countries are trading just about on every valuation metric you look at much, much cheaper multiples. And over long periods of time, those valuation differences are really what drive returns. So for the endowment, we were up 2.8% for the quarter, slightly trailing our policy index, and up 10.4% on a year-to-date basis. That's January 1st through June 30th. So a very, very robust start to the year. We gave up a little bit of ground to the benchmark for the quarter, largely because of, number one, our fixed income positioning, and I'll get to that in a minute. And second, more of a structural issue, which is falls under the alternatives bucket. We're in the midst of building a private markets portfolio, and for structural reasons, as you start building that portfolio, you often lag at the beginning, but over time make up that difference. And we hope that that area of the portfolio, once it becomes mature, will be a real driving force of performance for years to come. But as we are in the early stages, we are seeing a bit of a lag, and that's structurally causing some underperformance. With that said, the fixed income or bond book also underperformed. And if you think about what has happened with interest rates in the U.S., it really is phenomenal. The market began selling off, remember, in October of 2018, when the U.S. 10-year interest rate spiked above 3%. Now, to put 3% on the 10-year in historical perspective, that is an extremely low interest rate and far below average for the 10-year. Since that spike, the 10-year has gone from about 3.25% all the way down to today under 1.5%. That's a very, very dramatic move in interest rates. And with rates as low as they were, a lot of our bond managers were not positioned appropriately for falling rates. In fact, many of them expected higher rates. And as a result, we had some slight underperformance there. It's really been a dramatic move in the 10-year. And as you look at interest rates and you compare them to the move in stocks that we've had, which has been very positive in double digits year to date, it's a bit of a conundrum to figure out why rates are so low when the bond market is telling you one thing while the stock market is telling you something else. And if anybody has the answer as to why, we'd love to hear it. I think it's kind of the million-dollar question today. With that, other segments of the portfolio contributed positively. We have a slight overweight to U.S. versus non-U.S. equities. That helped. Our real estate portfolio has been generating very, very strong double-digit rates of return on an annual basis. That was a strong contributor as well. So let's flip forward to the non-endowment portfolios, and we'll start with the long-term portfolio. Again, from a time horizon standpoint, this long-term portfolio takes a long time period point of view when we're constructing it. It is much more tilted towards stocks rather than bonds, and therefore we would expect it to have higher rates of return while also having higher rates of volatility. The portfolio outperformed its policy index for the quarter, 2.9% versus 2.7%, and is now up 11.9% for the year-to-date period, just that 6 months. So once again, we've seen some very robust returns coming out of this segment of the portfolio. All segments of the portfolio contributed positively to returns for both the quarter and the year-to-date period. A slight overweight to U.S. stocks versus non-U.S. stocks was helpful. And we did have a different investment manager in the fixed income portfolio that helped us to actually outperform there, leading to that outperformance for the quarter. So strong results here, but it is a higher volatility portfolio, And so as we've had volatility over the last several weeks, it's certainly felt that volatility. And then finally, the medium-term portfolio. The medium-term portfolio is interesting. This is a more conservative portfolio with only about 30% in stocks and about 70% in bonds and cash. And if you look at the results, they've been very, very strong. Year to date, up 8.3%. Over the 1 year period, up 6%. So we've had strong results here, and this largely ties to my comments earlier on the move of U.S. interest rates. As interest rates decline, interest rates have an inverse relationship with bond prices. So as rates decline, bond prices increase, and that has led to some fairly strong gains, probably gains that we may not see again coming from the fixed income segment of the portfolio. So interesting that we have such strong results given that phenomenon. And then we'll end here on the short-term portfolio. Remember, the short-term portfolio is a portfolio that consists purely of money market funds. And money market funds have a yield that is tied to short-term interest rates. So we were in an environment where the Federal Reserve was tightening or increasing interest rates in the U.S. For the first time post the great financial recession in 2008-9, the Federal Reserve has just recently cut rates for the first time. So the Federal Reserve policy will have a lot of influence on the future results of this portfolio. You can see we're showing quarterly returns here, generating about 60 basis points or 0.6% per quarter. That adds up to well over 2% a year, but we'll expect that to start heading down given the most recent interest rate cut. So I think that concludes my remarks, and I'll hand it back to Brian.
Thanks, Matt. Thanks, Steve. Now, I'd like to take your questions. As a reminder, to submit your questions for the Q&A, please use the questions chat function in the menu bar. Our first question is, over the last year, the medium-term portfolio has outperformed the long-term portfolio and the endowment. Can you explain why?
Sure. And I think I'll take that, and it really alludes to my comments that we just recently made about the move in interest rates. So normally you think about a portfolio like the medium-term portfolio, a much lower return and lower risk portfolio. You think about that portfolio probably having a lower return than the long-term portfolio or the endowment, where we're taking on more risk, hence more volatility. But with this recent move in interest rates, and couple that with the volatility we've had in the stock market over the last year, it's resulted in this phenomenon that is unusual. So remember, the fourth quarter of 2018 was a volatile quarter. Stocks were down. At the same time, you had you had interest rates declining. So fixed income results were up. Since the fourth quarter, we've had an upward biased equity market, but we've also had a very strong bond market due to these lower interest rates. And so at the end of the day, the medium-term portfolio, having such a large chunk of its assets in bonds, has been very, very helpful. And again, it is unusual to see.
Yeah, let me add to that. I mean, I don't know why you want to focus on a shorter time period. If you look at 10-year time frames, and again, Matt appropriately said, our time horizon for the endowment portfolio is perpetuity, but That return, as you can see, is 8.6. The long-term portfolio is at 8.1, and that medium-term portfolio is 5.1. That's a heck of a premium, a 3.5% annualized premium on any reasonable amount of money over 10 years. You're looking at a huge dollar difference. So we place more weight on the longer-term numbers.
Thanks, Steve.
Thanks. Looks like we have one more. Can you comment on the rising trade tensions over the last couple of weeks and how it affects portfolios?
Yeah, I'll take that one. I said in a prior call that my worries going into the year were two things. One is a trade dispute becoming a trade war, or at least a major conflict. And then the other was fumbling by the Fed. Personally, I don't see a fumbling by the Fed. Trump's been incredibly critical of the Fed, including Powell, who he appointed. But when it comes to the trade, yes, I'm very concerned about the escalating trade issues. And I commented before that basically tariffs are a tax. And the issue is who's going to pay that tax. If the company pays it, they'll have less profit. If the consumer pays it, okay, but what's that do to demand? If the consumer prices are higher, the consumer is probably going to buy less in general cases where most goods are what they call price elastic. So the more you charge, the demand will drop. So one of the things the portfolio managers, of course, do is they factor this in and see, okay, well, what companies have pricing power where they're not going to have to absorb as much of that and where they'll still have reasonable demand. So we rely very much on our money managers to make strategic decisions about, based on tariffs, who are going to be the winners and losers. Matt also referenced, internationally. So there are obviously businesses both here and abroad, but particularly abroad, that are less impacted by a trade dispute between China and the U.S. So it really goes back to diversification. But yes, I continue to be very concerned, and it seems like if I didn't pay any attention to the news and somebody just said the market went down, I'd say, okay, what's going on trade? And then the market goes up. It's usually some sort of indication like we just had, well, the trade dispute might get resolved, or at least we're going to meet and talk again, and then the market rebounds. Over the long run, it's about fundamentals. How much do companies make over the long run?
Thanks, Steve. Thanks, Matt. If we didn't get to your question today during the Q&A, we will follow up with an email response. Thank you again for joining us today and for partnering with the San Diego Foundation to maximize the impact of your charitable giving. Today's presentation will be available by end of day tomorrow on our website at sdfoundation.org/investments. Thanks again and have a wonderful day.